Good evening, everyone. So we'll continue from where we left in the previous session on deferred taxation. So in the previous session, we understood the meaning of tax base. We understood the meaning of carrying amount, and the differences between these two will give rise to deferred taxation. Now, the difference can lead to a deferred tax asset or a deferred tax liability, right? Now, before we proceed further, I just quickly want to summarize when does something lead to a deferred tax asset and when does something lead to deferred tax liability. I know we have already covered in the previous day also, but one more time I want to recap, because once this concept is in your head, then it's very unlikely that you will forget. And please understand, this thing we will also use in, let us say, there is a business acquisition. When there is a business acquisition, carrying amount of asset will be different from the tax base. So if the carrying amount of asset is different from the tax base, then what is to be done, right? So that part we will understand again once quickly in summarized form, and then we will continue further, right? So you can have carrying amount and tax base. You can have carrying amount, or you'll have carrying amount and tax base, and it can be for an asset and it can be for a liability. So you have carrying amount of and the tax base, which you need to compare. You have to compare basically the carrying amount of asset and the tax base, carrying amount of liability and tax base, and accordingly we'll have to decide. Now, if carrying amount of asset is greater than the tax base, if carrying amount is greater than the tax base, for example 10,000 here, 8,000 here, carrying amount is greater than the tax base. Now this difference will lead to a deferred tax liability. If asset carrying amount is more, in our books it is more, then it will result in a deferred tax liability. If carrying amount is less, 10,000, let us say 12,000, this will result in deferred tax asset. Now when it comes to liability, if carrying amount is greater than the tax base, if carrying amount is greater than the tax base, now when the asset value is more, we said DTL. When liability value will be greater, we will say DTA. Similarly, for liability, if the carrying amount is less than the tax base, this will result in DTL. This is something in a summarized manner which you should keep in mind, or which you should note, so that you don't forget. Most of the times questions are based around asset and not on liabilities, because generally, I know there would be cases where liabilities also there is a difference, but generally in the books you will see asset amount being different, and in examination also major focus will be on the assets. But if you have understood this, that yes, if the difference is because the carrying amount is greater for an asset, it is a DTL. If for a liability, if it is greater, then it is DTA. So this is you have to remember. This is something you have to remember, because in the examination you cannot go back and think logically. If this is this, then in future we will have higher taxable income, lower taxable income, then calculation, waste of time. So some things which we need to remember. See, we have understood the logic. Something which needs to be remembered by heart should be remembered by heart, and this is one thing which I want all of you to remember, so that you don't waste time in the examination. Right? Now, what the standard says is, because of these differences, temporary differences. Now, if you look at Ind AS 12, unlike AS 22, we don't have this distinction between temporary, permanent, and all of that. If there are differences, then those differences may result in taxable differences or deductible differences. If it is a taxable difference, we call it as DTA, that is these two cases. In these two cases, we say there is a taxable difference, and taxable difference is DT. I made a mistake, I'll make it deductible. Deductible difference will result in a DTA, and taxable difference means it will be taxed in the future, will result in DTL. Now, what are the case of deductible difference? This case and this case, where you have the asset being lower and liability being more. That is a deductible difference. And when it is a taxable difference, when asset is higher and liability is lower, it becomes a taxable difference. Right? Now, one more thing, sir, why is there not a permanent difference kind of a scenario? Because if we said, right, if the differences does not result in taxable amount or deductible amount in the future, then it will not be considered for deferred tax purpose, and hence it will automatically become permanent. For example, just to give you a perspective, let us say there is a liability. This liability is for, let us say, wages payable. Not wages, but penalty payable. Penalty. Liability is for penalty. Okay. Now this penalty will not be allowed for taxation purpose. Liability will not be allowed for taxation purpose. Then what will happen? My tax base of liability will be carrying amount of liability. So let us say this is 1000. This is my carrying amount. And for what will be the tax base? Tax base will be 1000 minus amount that will be allowed in the future, 0. This will also be 1000. So 1000 minus 1000, there is no difference. 1000 minus 1000, there is no difference, and hence the question of deferred taxation does not arise. Is that clear? Any question on this? No questions. Okay. Now, whenever there is a taxable difference and whenever there is a deductible difference, we need to recognize DTL and DTA respectively. There are some exceptions. Now, what are the exceptions? Let me just just give me a moment. I'll share another screen. So far we have understood what is the meaning of your carrying amount of and the tax base. We have calculated all of these aspects. We have already completed. Now we will recognize, but there are certain exceptions. What are the exceptions? The first exception is goodwill arising on business combination. There is a small amendment this time that they have added one more line item, but and anyways covering that as a part of RTP, but nothing much to be bothered about. What you need to understand is, if there is goodwill which is arising at the time of business combination, no deferred tax liability is recognized on any taxable temporary differences which arises on goodwill which is not tax deductible. What is the meaning of this? See, whenever we have a business combination, we create a goodwill, right? Goodwill is created, but for tax purpose, goodwill will not be created. For tax purpose, goodwill will not be created. Now, if goodwill will not be created or goodwill will not be allowed for deduction, so normally when you have a business combination, you recognize something called goodwill. If it is not allowed for tax purpose, that is, goodwill is not tax deductible, then in that case, what we do is, we do not recognize any deferred tax liability. And the logic is, if you recognize deferred tax liability, the liability will increase, again goodwill will increase, again liability will increase, again goodwill will increase. It will be a vicious cycle, and hence we do not recognize deferred tax liability which arises on goodwill which is not taxable. Okay, that's the first thing. Then, if goodwill is tax deductible, then DTL is recognized. That's the first one. In the second point, there is a small amendment where they have added one more item, which, as I told you, I'll cover as a part of RTP, and I've already covered it as a part of RTP. When we release that, we'll understand it, right? So, what is the second part? Second exception. So this is the exception, means you will not recognize DTL in these cases. Normally, whenever there is a taxable temporary difference, you will recognize DTL, but if it is goodwill which is not tax deductible, for that you will not recognize DTL. And because the reason is, it will result in vicious cycle. DTL liability increases, then again goodwill increase, so it will not be feasible to have it, right? That is the first exception. The second exception is in case of initial recognition of asset or liability for a transaction which is not business combination. First thing is the transaction should not be a business combination. Sir, why not business combination? For business combination, we have separate treatments. For goodwill we already saw, and if it is a business combination, we'll handle it as per Ind AS 103. So, in other cases where there is a transaction which is not a business combination, then second condition is it does not affect accounting profit or taxable profit. So, you have acquired an asset or a liability. In a transaction which is not a business combination, meaning to say maybe simply you have purchased it. Right? Now, when you have acquired that particular item, or you have recognized that particular asset, then it is not a business combination or transaction in business combination. Second is it does not impact the accounting profit or taxable profit. Means this particular item will not impact my accounting profit, neither will it will impact my taxable profit. For example, an entity acquires a foreign made vehicle for rupees 1 lakh directly from the vehicle manufacturer. The transaction is not a part of business combination because we do not have business combination accounting. The tax laws do not permit any depreciation thereon. The tax laws do not allow any depreciation thereon. So you have some restrictions, right? You cannot claim depreciation on specific type of assets. Also, the profit on the sale are not taxable, losses are not tax deductible. So this transaction does not have any business impact. First thing. Second, because there is no business impact, the tax base is nil because we will not get any deduction. However, the standard, because it does, see, when I acquire an asset, that asset which I have acquired will not impact my taxable profit. So either it should not affect my accounting profit or taxable profit. Now here it does not affect my taxable profit. Because it does not affect my taxable profit, I will not create a DTA or DTL in this case. So this is more like a case where we say, something like a permanent difference, where or exempt income or expense which are not allowed, which will not be allowed in the future, and hence you do not consider that for your deferred tax liability calculation. For examination, just remember that there is something like exception list. Now here one more item which is added is whatever this, there is a third condition added to this here. First condition, second condition. The third condition says that the taxable difference or the the deductible difference which arises on account of initial recognition at the time of transaction does not give rise to equal taxable and deductible temporary difference. Means it should not give rise to equal, means same amount of taxable as well as deductible temporary difference. Means on one side there is taxable, on the other side there is deductible. Such kind of scenario should not happen. Okay, so the one more condition, but more often, more importantly, you need to remember that there are these two exceptions. Here a third item is added which says that if it does not result in equal taxable and temporary difference. So if these three conditions are satisfied, then in that case you do not recognize the DTA or DTL as the case may be. Now, whenever we do the accounting for associates, joint, interest in joint ventures and all of that, sometimes what happens is the tax base will be different from the carrying amount. For example, associate is there. Now we have understood that in associate accounting we add the share of profit. Now as far as taxation is concerned, taxation says your cost will be cost. You will not be able to change the cost. But for my accounting purpose, I am adding the profit, my carrying amount is changing. Now what the standard says is, you will not recognize DTL if the parent investor or venturer is able to control the timing of reversal of the temporary difference. Now what kind of temporary difference are we talking about? For example, investment cost 1000. Let me just share the screen. Investment cost 1000. Add profit 500. Okay, what is the carrying amount? 1000 plus 500, 1500 is the carrying amount. What is my tax base? Tax base is still 1000. Tax base doesn't change. Now what the standard says is, now for this difference you will not recognize a liability if the investor or the joint venturer they can control the reversal. Now when will it reverse? It will reverse when you pay the dividend. If for example the dividend is paid, then it will reverse. So if they are able to control the timing of reversal, then you will not recognize DTL, or it is probable that the temporary difference will not reverse in the foreseeable future. Meaning to say, we will not get dividends, this temporary difference will not reverse, hence we will not recognize a DTL. First scenario. Second, DTA will be recognized if the temporary difference will reverse in foreseeable future and taxable profit will be available against which temporary difference could be utilized. So in case of joint venturers and all, this is the scenario where there is a temporary difference, right? Because of the temporary difference, there could be a taxable temporary difference or deductible temporary difference. Now whenever such kind of differences arises, if the joint venturer or if the associate, if they are able to control the reversal, then you will not recognize the DTL. Then second, if temporary difference will reverse means we will be able to reverse and we'll have taxable profit. We'll understand that for DTA aspect, there we will recognize the DTA in that scenario. Are we clear? So for DTA we have to see whether it will reverse and whether we will have taxable profit. For DTL, you will not recognize DTL if reversal is in the hands of the investor or joint venturer or the parent, and it is probable, and the second scenario is it is probable that the difference will not reverse in the future. Jawar, example for what? You have to be more specific because I saw the comment just now. Now, please understand the next aspect. When we talk about deferred tax asset means we are saying that we will get future economic benefits. Now, it may so happen that, for example, there is a deductible temporary difference for which you have recognized DTA. Let us say deductible temporary difference is 1 lakh. DTA is 1 lakh into 30%. I am assuming 30% for simplicity. In examination, don't get into 30%. Don't carry that. 30% is for understanding. Now, if 30,000 is the DTA and we are saying we will have 1 lakh deductible item in the future. In future, if you have to deduct the item, you need to have taxable profit. So if you do not have taxable profit, how will you deduct this item? So that is where what the standard says is an entity should recognize DTA only when it is probable, means greater than 50% chance that sufficient taxable profit will be available against which the deductible temporary difference can be utilized. Meaning to say, if you will have taxable profits in the future, then in that case, whatever is the deductible temporary difference, for that you will recognize DTA. If the company is loss making, if the company believes that you will not have taxable profits in the future against which you can deduct the deductible differences, then in that case you will not recognize a deferred tax asset. Right. Same way, another thing what happens is, if let us say in year 1 there is a taxable loss from tax. Okay, there is a loss. In year 2 there is a profit of 1,50,000. Now tell me one thing, on what amount will we pay tax in year 2? Yeah, on what amount will we pay tax in year 2? Sorry, I'll just share this screen. I keep on forgetting. Yeah. If the loss as per in year 1 is 1 lakh and profit in year 2 is 1,50,000, what is the profit amount on which we'll pay income tax? 50,000, right? So what happens? 150 minus 1 lakh, 50,000. So what is the tax? Tax payable will be 50,000 into 30%. This 50,000 into 30%, this is the current tax. This is the current tax. Now, here when you have loss in first year, please see this. Because there is a loss in first year, you will pay less tax in the future. So here you will recognize a DTA of 1 lakh into 30%, which is 30,000. Okay, and this will reverse when you have profit. So here you will have a reversal of 30,000. Okay, so here you will have income tax benefit of 30,000, and here you will have income tax expense of 15,000 plus 30,000, 45,000. Current tax plus deferred tax expense or reversal of deferred tax will be 45,000. Right now, if I have to recognize this deferred tax asset in the first year, I must have, or there must be a possibility that in the future I will have taxable profit. If in the future also I don't have taxable profit, here also if there is a loss, here also if there is a loss, means I will not pay any tax. I will not pay any tax. If I'll continue to have losses, it is not prudent that I should recognize a deferred tax asset. Okay, so what the standard says is, if there is tax loss, means unused tax loss or brought forward tax loss, whatever we call it, a deferred tax asset shall be recognized for the carry forward of unused tax losses and unused tax credits to the extent that it is probable that future taxable profit will be available against which unused tax losses and tax credits can be utilized. Tax credit is something like MAT, minimum alternate tax. Okay, so you will recognize a deferred tax asset for brought forward tax losses only if there is a possibility or there is probable that in the future you will have taxable profit. Means there has to be a probability. Okay, now if you have unused tax losses, means brought forward tax losses, there is a high chance that in future taxable profit may not be available. So if taxable profit is not available in the future, you have to assess whether we should recognize deferred tax asset or not, and you will recognize deferred tax asset only to the extent that the entity has sufficient taxable temporary difference, or when there is a convincing other evidence that sufficient taxable profit will be available against which the unused tax losses can be utilized. So simply put, if I have brought forward losses, I will recognize deferred tax asset only if it is probable that in future I will have taxable profit, or in future I will have some taxable temporary difference against which I can utilize this brought forward losses. Otherwise, I will not recognize the deferred tax asset for such cases. And at the end of each reporting period, we should reassess the deferred tax asset. So whatever we have not recognized and also whatever we have recognized, we will reassess and see whether in future we will have taxable profit to recognize the asset or not, DTA or not. So Jawar, the third condition means, are you talking about the subsidiary joint venture or the third condition which got added? Okay. Let me share the screen. Now, sometimes what happens is when you initially recognize an asset, there would also be a liability which is correspondingly getting recognized. For example, if there is a decommissioning cost. Now, this decommissioning provision, what do? You add it to cost of asset. Do you add decommissioning provision to the cost of asset as far as your income tax is concerned? Does income tax tell you to add present value of decommissioning provision to the cost of asset? Decommissioning, as per books of accounts, you will add it to the cost of asset. Now, the next question is, will you add the decommissioning cost which is there? Will you add that in the cost of asset as per the taxation provision? Okay. Now there will be a difference. Then you also have an expense called decommissioning liability which you amortize or depreciate. Now for taxation, they will not allow this depreciation on this decommissioning liability or the amortization of decommissioning liability. All of that will be allowed only on payment basis. Okay. Now here, both of these are equal. The decommissioning provision which is added to the cost of asset and decommissioning liability which is created as a liability, both of these are equal. So in such cases, when both of these are equal, then the condition is not met. What the standard says is both of them should not be equal. Okay, only then the exception comes into picture. If both of them are equal, then the exception does not come into picture. Slightly complicated and at a higher level. I don't think this will be tested for the examination other than the amendment specific condition. But then, if in such scenarios you are creating for the same transaction an asset and a liability. We are creating both an asset as well as a liability. One is causing a deductible difference, one is causing a taxable difference of the same amount, right? That is one example for the third exception. Okay. Now moving on. Moving on, what should be the tax rate that you have to consider? So, tax rate, what the standard says is, you should apply that tax rate. You should apply that particular tax rate which will apply to the period when the asset is realized or liability is settled. So, I am creating deferred taxes for future. Go to the future and look at the enacted and substantively enacted tax rate. So, if it is already enacted or if it is substantively enacted, use those tax rate and account for the deferred taxation. Okay. Now, sometimes it may happen that your current tax rates are different from the future enacted tax rate or expected tax rate. You will use the tax rate which is expected to be enacted or substantially enacted for the future. For example, budget is passed, but president has not yet given his signature or her signature, right? In that case, what you will say, it is enacted, substantively enacted means most likely to get enacted. Now, a quick summary of accounting entries we have already seen yesterday. Whatever is the current tax, that is tax payable on the current income, that you will debit to income tax expense current and you will credit to income tax payable. For deferred tax asset, it is a benefit. It will reduce my income tax. So, you will debit deferred tax asset, credit income tax benefit deferred. For DTL, exactly reverse. If I am assuming a liability, it will add to my expense. So, you will debit the income tax expense and credit the deferred tax liability. Then tax expense in PNL is nothing but your current tax plus the deferred tax expense minus the deferred tax benefit. In the balance sheet, we present the deferred tax asset and deferred tax liability as a net amount. Few things, it is always shown as non-current. Even though it is non-current, these are not discounted. Sir, where to report deferred tax? Depending on what is the item. So, if it is a P&L item, you will report the expense and benefit in the P&L. If it is an item pertaining to other comprehensive income, you will report in that particular aspect. Okay. Now, an entity shall offset deferred tax asset and deferred tax liability. So, I said, right, you have to present it on a net basis. You will present it on a net basis only if the entity has a legally enforceable right to set off the current tax asset against the current tax liabilities, and the deferred tax liability, asset and liability relate to the same income taxes which are levied by same taxation authority on either the same taxable entity or different taxable entity which intend to either settle the current tax liability and asset on a net basis or realize the asset and settle the liability simultaneously. Slightly complicated way of wording. Very simply put, if we have the right to offset the asset and the liability, we will show it on a net amount, and it has to be from the from those authorities which are the same. The taxable entity has to be the same, or even if it is different taxable entity, they settle the current tax liability and asset on a net basis. Now, this is more relevant in case of consolidated financial statement where you have different subsidiaries. Well, let us say Reliance has 3 subsidiaries. Now, one has deferred tax asset, another has deferred tax liability. You cannot offset them because from taxation point of view, each subsidiary is different. Okay, or you have branches in different locations. One branch is in the US, one branch is in India. Indian branch has to pay a tax in the as per Indian laws. US branch has to pay tax as per the US laws. Now, in that case also, we cannot offset. One asset Indian, liability US, you have to show it separately. Now, specific cases and practical application. Business combination. Whenever there is a business combination transaction, then you will recognize any resulting deferred tax asset and deferred tax liability as identifiable asset and liabilities on the acquisition date. So here what you need to keep in mind is, whatever is the deferred tax component, whether it is an asset or a liability, you will treat them as a separate asset or liability for the purpose of calculation of goodwill. Then you will not recognize deferred tax liability arising from initial recognition of goodwill. So that is one more thing that you will not recognize on initial recognition of goodwill. In India, again, you know that goodwill thing, you may not get a deduction and hence you will not recognize. Then, as a result of business combination, there may be some cases where deferred tax asset of the acquirer could change. For example, I have huge losses. I have huge losses. In future also, I am expecting that there will be losses. So what did I do? I acquired a profit-making company. Now, after I acquired a profit-making company, I will be able to utilize my brought forward losses. So in that case, what will I do? I will recognize the deferred tax asset. Then, if there are some potential benefit of income tax carry forward losses or other deferred tax asset, they may not satisfy the criteria of separate recognition when a business combination is initially accounted for, but might be so. At the time of recognition, you may not have initial recognition, you may not satisfy the criteria, but subsequently it may be possible that we may realize those deferred tax assets. So if the new information has been obtained within the measurement period, then we will make adjustment to the assets or liabilities. Otherwise, you will recognize subsequently in the P&L. So the meaning of this is, when I did the initial accounting, acquisition accounting, I could not identify the deferred tax asset for lack of information. Now, if the information is obtained within the measurement period, how much is the measurement period? Let me see how many of you remember. How much is the measurement period for deferred tax for business combination under Ind AS 103? The measurement period is 12 months. So, if you get the information within 12 months, then in that case, you will recognize. Otherwise, you will not recognize, you will take it to subsequent P&L. Then share-based payments. Now, whenever there are share-based payments, yes, 1 year, Mohan Kumar, good. Whenever there is share-based payment, you will recognize as expense as per Ind AS 102. So, as per Ind AS 102, we have understood, we will recognize share-based payment, right? Now, that is from accounting point of view. From taxation point of view, whenever the employees exercise the share option, that point of time we will get the deduction. So, you have whatever you will get deduction in the future, that will be the tax base, and the carrying amount will be 0, because in the books there is nothing called the share based payment expense, but from the tax point of view, in the future you will have deduction. So you will recognize a deferred tax asset for the temporary difference. Then sometimes there may be a change in the tax status of the entity, meaning to say, you may be from taxable entity, now you have become non-taxable entity. That is, currently you are being taxed. Government comes up and says, okay, these kind of businesses, you don't have to pay tax for 5 years or it is exempt. Or you have become a charitable organization, right? So, what you have to do is, whenever there is a change in tax status, then you have to identify what will be the consequence of the change in tax status. And accordingly, the current and deferred tax consequence of a change in tax status, you will include in the P&L for the period. That is, if for example, I was a non-taxable entity and now I became a taxable entity. So now I'll have a current tax payable that will be recognized. If I am a non-taxable entity, I may not have deferred taxation. Then subsequently I become a taxable entity, I will have deferred taxation. So the current and deferred tax consequences of a change in tax status shall be included in the P&L. Means you will recognize it in the P&L for the period, unless those consequences relate to transaction and event that result in same or a different period. Means if it impacts the future period, then you will not recognize in P&L for the current period. Okay, or it will go to OCI also. If it is something related to OCI, you will take them to OCI as well. Presentation, as you have already seen, current assets and current tax liability means currently if I have a tax payable and I have also paid advance tax, or there is a TDS, that is a current tax asset. So current tax asset and current tax liability we can offset if the entity has a legally enforceable right to set off the recognized amounts and it intends to either settle on a net basis or to realize the asset and settle the liability simultaneously. A simple example for this is, say for example, there is advance tax paid. I have paid advance tax, and then there is income tax payable. Can I offset both of these and present it at a net as a net item? Of course, yes, because I have a legally enforceable right. Okay. Same way, you can offset deferred tax asset and deferred tax liability if you have legally enforceable right to set off current tax asset against current tax liability, means here, and they are related to same entity and it may be related to different taxable entity, but they intend to settle it on a net basis, right? Most likely in our case we will see if it is a same taxable entity. For different taxable entity you will not have the ability to set them off in the offset them against one another. Then tax expense related to profit or loss from ordinary activities shall be presented at the part of P&L. The aggregate current and deferred tax relating to items that are credited directly to equity, there you will show it under OCI, and the amount of tax income tax relating to each component of OCI. So it could be either equity item, OCI item, or P&L item. So these are various disclosures that you are required to do. So this covers the basic aspect of your deferred tax asset and deferred tax liability. Now what we'll do is we will take a few questions for our understanding. Any questions on this so far? Let's have a look at this question. A prepares financial statements to 31st March each year. The rate of income tax applicable to A Limited is 20%. The following information relates to transactions, assets and liabilities of A Limited during the year ended 31st March of year 2. A Limited has 40% shareholding in L Limited. A Limited purchased this shareholding for 45 crores. The shareholding gives A Limited significant influence over L Limited but not control. Therefore, A Limited accounts for its interest in L Limited using the equity method. The equity method carrying value of A Limited's investment was 70 crore on 31st March and 75 crores on 31st March of year 2. In the tax jurisdiction in which A operates, profit recognized under equity method are taxed if and when they are distributed as dividend or the relevant investment is disposed of. Now what does this mean? This is a scenario where you have your investment in associate. Which method of accounting do we follow for investment in associate? Which method of accounting do we follow for investment in associate? We have covered, already completed, or you would have missed the class. Anybody? investment in associate is accounted for using the equity method. Now in the equity method, what we do is we increase the value of investment by the profit that is earned. We increase the value of investment by the profit that is earned, and please understand that the income tax impact will happen only when we receive the dividend. Now what is the question? The question says that based on the above information, you are required to calculate the deferred tax liability of A Limited on 31st March of year 2. So, on 31st March of year 2, what will be the deferred tax liability? Now, for calculation of deferred tax liability, we need to know what is the carrying amount. Carrying amount is 75 crores. What is the tax base? Tax base is 45 crores. What is the difference? 30 crores. Difference is 30 crores. Tax rate is how much? 20%. So 30 crores multiplied by 20%, we get 6 crores. So 6 crores is my deferred tax liability as far as investment in L Limited is concerned. Second, it says A Limited measures its head office using the revaluation model. The building is revalued every year on 31st of March. On 31st March of year 1, carrying value is 40 crores, tax base is 22 crores. On 31st March of year 2, they charge depreciation 2 crores and claimed a tax deduction of 1.25 crores. On 31st March of year 2, the building was revalued to 45 crores. Now, 45 crores is the revalued amount. 45 crores is the revalued amount, which is nothing but our carrying amount. So the carrying amount is 45 crores. What is the tax base? Tax base is my opening balance, that was how much? 22 crores minus tax depreciation 1.25 crores. So 22 minus 1.25 crores, if you do, you get 20.75 crores. My head office, my book value is 45, my tax base is 20.75. There is a temporary difference. Now this temporary difference, how do we look at it? My carrying amount of an asset is greater than the tax base, it will result in a deferred tax liability. You multiply it by 20%, you get a deferred tax liability of 4.85 crores. Now, the total deferred tax liability is 6 crores from this and 4.85 crores here, it is 10.85 crores. Right? Now, please understand, you have to read the question also carefully. The first part of the question says deferred tax liability as on 31st March of year 2. Deferred tax liability as on 31st March of year 2 that we have calculated. The charge or credit to P&L and OCI relating to deferred tax. Now, why are we saying OCI? See, we are saying OCI because this item impacts the OCI and the first item impacts the P&L. Now, how do we know what is the P&L balance for, or what is the amount to be taken to P&L? For that, you have to compare what is the opening balance of deferred tax liability and what is the closing balance of deferred tax liability. So, like we did 75 minus 45, we have to do 70 minus 45. So, 70 minus 45 is how much? 70 minus 45 is 25. Similarly, for 25, so there are two ways to do. For 25 into 20%, my opening DTL would have been 5 crores. My opening, sorry, 25 20%, yeah, 5 crores. With this temporary difference, my opening DTL would have been 5 crores. My closing DTL is how much? 6 crores. So 1 crore should be charged to the P&L. 1 crore should be charged to the P&L. Same way for head office building. DTL as on 31st March is 3.6 crores. We can calculate that. How do we calculate DTL on 31st March? Tax base, carrying amount minus tax base multiplied by the 20% tax rate. 3.6 is the closing liability and current period closing liability is 4.85 crores. So, you have 4.85 crores of new deferred tax liability and you have 4.85 of the closing deferred tax liability and 3.6 of the current deferred tax liability. I'll actually do it on an Excel, that will be easier for us to understand. Just a moment. Building, okay. Year 1, carrying amount, tax base. What is the carrying amount? Let me just take it up. The building was revalued every year. On 31st March, the carrying value of the building is 40 crores. 40 crores. What is the tax base? Tax base of the building is 22 crores. Then what did you do? You did depreciation. You charge depreciation. What is the depreciation? Depreciation 2 crores. For tax purpose, depreciation is 1.25 crores. So 40 minus 2, 38 crores, and 22 minus 1.25 crores, you get 20.75 crores. So you have 38 crores and 20.75 crores. Now 38 minus 20.75 crores, what is the difference? 17.25 crores is the difference. 17.25 crores is the difference, right? Now this 17.25 crores, whatever we have got, the difference between the tax base and the accounting base, what is the DTL impact of this? The DTL becomes 3.45. The DTL becomes 3.45, right? This is the DTL on sorry, this is as on 20 year 2. Okay, so the DTL should be 3.45 crores before revaluation. The DTL should be 3.45 crores before revaluation. What is the DTL on year 1? The difference is 18 and the DTL should be 3.6. So the opening DTL is 3.6. The closing DTL before revaluation is 3.45. The difference between these two, the liability has come down. There is a reversal of DTL. This reversal of DTL should be recognized in P&L. Sir, why are we recognizing this in P&L? We are recognizing this in P&L because the difference has arisen because of depreciation. The difference has arisen because of depreciation. That will be taken to P&L. Reversal of DTL, credit to P&L. So then what is the next thing? Then after that, what we have to see is carrying amount has become 45 crores and the tax base is 20.75. What is the difference? The difference is 24.25. So because of this difference, now we have a liability of 4.85. Right. Now this liability of 4.85 is what? The liability of 4.85 is something pertaining to your closing balance because of revaluation. 4.85 is closing balance because of revaluation. Now from 3.6 to 3.45, the change has an impact on the P&L. From 3.45 to 4.85, that is because of revaluation gain. This will, the difference 4.85 minus 3.45, this difference will be credited to OCI or debited to OCI actually, because it's a liability. Will be debited to OCI. Any questions here? Any questions here? Great. Let's look at one more question. We'll have more clarity after that. See, conceptually this chapter is pretty simple. You need to practice more and more. That is what is important. Okay, now K Limited prepares consolidated financial statement to 31st March every year. During the year, K Limited entered into the following transactions. On 1st of April, K Limited purchased equity investment for 2 lakhs. The investment was designated at fair value through other comprehensive income, Ind AS 109 financial instrument. On 31st March, the fair value of instrument is 240. In the tax jurisdiction in which K operates, unrealized gains or losses on the revaluation of investment are not taxable. Now, if it is not taxable, means it will not impact the tax base, right? So carrying amount is 2 lakhs. When my carrying amount is 2 lakhs, and my carrying amount is 2,40,000 and my tax base is 2 lakhs, there is a difference. Now what is higher? My carrying amount is higher. If my carrying amount of asset is higher, what does it relate to? or what does it create? It creates deferred tax liability. So 240 minus 2 lakhs on 40,000 I will create deferred tax liability, and the rate is 25%. We'll multiply with 25% and get it. Then second one. On 1st August, K Limited sold products to A Limited, wholly owned subsidiary operating in the same tax jurisdiction as K Limited, for 80,000. The goods had cost K Limited 64,000. By the year end of 31st March, A Limited had sold only 40% of these goods. Now, what happened here? In the second case, what happened is we sold goods costing 64 at how much? 80,000. How much profit did we make? 80 minus 64, 16,000 of profits is what we made. Now, 16,000 of profit, whatever we have made, we have shown, we would have made a profit, and accordingly, the selling company would have recognized a income tax expense in the books. Okay. Now, in the consolidated financial statements, what will happen? We will say that in the consolidated financial statement, there is an inventory of unrealized profit, or there is an inventory which is shown at a higher value. There is an inventory which is shown at a higher value. Now, my cost is 64, my profit is 16,000. Out of that 16,000, 60% is unsold. If my 16% is unsold, what will I do? 60% of this 80 minus 64, that is 16,000. 60% of 16,000, 9,600 I will reduce from the inventory. 9,600 I will reduce from the inventory. My carrying amount of inventory has gone down, whereas the tax base will remain the same. Now, because of this, what will happen? This will create a deferred tax asset. Please remember, if carrying amount of asset is higher, it is a DTL. If carrying amount of asset is lower, it is a DTA. Sir, why is carrying amount of asset lower here? Because 9,600 is unrealized profit. I will reduce it from the consolidated financial statement as unrealized profit from inventory. This will create a deferred tax asset. Then, on 31st of October, K Limited received 2 lakhs from a customer. The payment was in respect of services to be provided from 1st of November to 31st of July. K Limited recognized revenue of 120 in respect of this transaction in the year and will recognize remainder in the next year. Under the tax jurisdiction, 2 lakhs received was included in the taxable profit for K Limited the same year. Now, what has happened? Here, if you see, I have received from customer how much? 2 lakhs. I have recognized revenue of 1,20,000. What is the difference? 80,000 is the difference. What is the difference? 80,000 is the difference. Now, this 80,000 of difference, how will I show it in the balance sheet? In the balance sheet, I will show it as a liability. In the balance sheet, I will show it as a liability. Correct? That amount of liability, what is the tax base? See, for the tax base, it is 0 because everything has been taxed. It is 0 because everything has been taxed now, and nothing will be taxed in the future. So, the tax base is 0. 80,000 minus 0, 80,000 is the amount, and this 80,000 of amount, because the carrying amount of liability is higher, it will result in a deferred tax asset. Or the other way to understand that is, we have already given it for taxation. In the future, there will not be any tax impact. Hence, it will create a deferred tax asset. So, on the balance amount, you will create a deferred tax asset. Any question? No questions? Great. I hope this clarifies, the aspect on Ind AS 12. Go through the disclosures from the notes. You can revise it quickly. The study material is unnecessarily bulky. So, if you can just finish the questions given in the notes that I have shared with you, that will be more than sufficient for you to practice the questions for the examination. The study material has a lot of theory. So, we have actually tried to compress all the theory and tried to summarize it to the extent possible. I hope this has helped you revise Ind AS 12 pretty quickly, and it will help you prepare well for the examination. Any questions, or we'll call it a day and we'll continue tomorrow. But the only thing is that chart, carrying amount, tax base, asset, liability. If you remember that, 90% of the questions you can solve it straightforward. Chalo. Thanks a lot, and have dinner and have a good night.